All right, hello, Econ kids. Today, continuing on our thoughts and ideas and notes about monetary policy and the entity that does monetary policy is the Federal Reserve. Now, the Federal Reserve was given by Congress what we call a dual mandate. So that dual mandate, dual means two, that they need to stick to, or they were given a directive. A directive means this is what you're supposed to do. And they're supposed to direct monetary policy. Remember, monetary is stuff to do with money and interest rates. They want to promote maximum employment and stable prices. So maximum employment, that's going to be no recessions. Stable prices is going to be no inflation. Okay, so remember, we don't want those spikes like we had with the business cycle where we have bad recessions or really bad inflation. So that dual mandate is what the Federal Reserve has been directed by Congress to do. And they do that through monetary policy. So monetary policy is different than fiscal policy. Remember, fiscal was taxes and government spending. So monetary policy is it's the process by which the Federal Reserve Bank sets rates and manages the money supply to influence interest rates and to fight inflation or recession. So the way they do this monetary policy, one way they used to do, and this was pre-2008 when this worked, so before the Great Recession, because that recession changed a lot of things, and we'll get to that later. So some of the ways they manipulate is through changing the money supply. And one of their tools is called the reserve ratio. So that's the percentage of demand deposits, that's the money we put in the bank, that the bank has to hold on to and not loan out. So we don't want runs on the bank like the Great Depression. Now the amount of money is called the required reserves. And that's the dollar amount that banks can't loan out. What they can loan out is that extra or excess reserves. That they can loan out and try to make money off your demand deposits. Or checkable deposits, that's the monies that bank customers deposit. Okay? So the assets are what the bank owns. That means that they own the loans they issue. They can buy and sell them in the market. They can use them as collateral. They can do a lot of stuff with them. But liabilities are what the bank owes. So they owe you your deposit. If you show up and you want your money out of the bank, they have to give it to you. So those are liabilities. Now, if you add together the assets and the liabilities, if you add together the required and excess reserves, that gives you your total reserves. That's what the bank keeps in their vault, in their online deposits with the Fed, things like that. So how we figure out that these deposits can become more money than they originally were is through what we call a money multiplier. And that is actually going to be 1 divided by the reserve ratio. Now, when we're looking for a change, we use a triangle. That means change. Or the symbol delta. Steal that from science. So a triangle or delta means change. And so we're going to have a change in the money supply. So, a little bit of review. Don't forget that the money supply is made up of M1, cash, coins, checkable deposits, and savings, and of course M2 as well, but we focus on M1 since it's the biggest component. And what we're looking for are changes to the money supply. So that's what the triangle means. We're going to try to increase it or decrease it. And that will lead to a change in our interest rates, which is the target. All right. So the other thing the Federal Reserve Bank can do is called an open market operation. That is the buying or selling of bonds by the Federal Reserve Bank to increase or decrease the money supply, which will raise or lower interest rates. So think about it like this. If the money supply increases, that means there's more of it. And the price of money is the interest rate. So if there's more of something available, the price is going to drop. So if the interest rate drops, that means more people are going to borrow and invest. So same thing with money supply decreasing, there's less of it. That's going to make the interest rates rise and battle inflation. So there's two types of these open market operations. First one is they can buy bonds, and that makes big bucks. So what that means is that the Federal Reserve buys bonds off the market, and that increases the money supply because they're putting more money into the money supply, and that lowers interest rates. The second thing the Fed does is sell bonds to make small bucks. So the Fed sells bonds to the market, and that decreases the money supply and raises interest rates, just like we did over here. So that's the whole point of it. They're going to buy and sell these bonds, and the bonds are just like I showed you in the last lesson. They're a loan from the public. And those bonds, think of the Federal Reserve Bank as being separate from the money supply and all the people. They sit above it and they make policies. When they buy bonds, they put the money into the bank, then the bank can loan it out. So that increases the money supply and lowers the interest rate. The other things they can do, so we can kind of separate open market operations. And one thing they can do is change the discount rate. That is the rate that the Fed charges banks to borrow money so they can loan it out. So if a banking system, or if say a big bank wants to make a lot of house loans, they can call up the Fed and they can borrow at what's called the discount rate, and then they can use that money to make loans and then charge more on the loans and keep the profit. If they don't want to borrow from the Federal Reserve Bank, they can actually borrow from each other. So the federal funds rate is the rate at which banks charge each other for borrowing money. So if I'm at Bank of America and I want to borrow money from DATCU, I call them up, and by law, they have to loan me money at this rate. If I say, hey, I got a customer that needs to borrow $1 million, can I borrow $1 million to loan to them? They have to do it at that Fed funds rate. So the Fed can actually target what's called the prime rate. And that's the interest rate banks charge their best customers. So best customer means someone with the best credit, best job history. They'll get charged the prime rate, and that's usually set about 3% higher than the Fed funds rate. So if the Federal Reserve wants to slow down the buying market and battle inflation, they would raise the Fed funds rate, and then banks would charge 3% above whatever the Fed funds rate is. And that's how they conduct their monetary policy, by changing these two rates and influencing the prime rate. Now, this was all done before 2008 because obviously the Great Recession caused a lot of problems. So this is page 1. If you need to see this, you can pause it right here and get all this part down. Then on the back page, we're going to apply this stuff.